thanks everyone for coming today. So hopefully today in my 30-minute spiel, I'll be talking about tax strategies and tax tips for you guys who are property investors. So it's just 30 minutes, so I'll try to cover as much as I can, and hopefully you get a lot out of it, and please ask questions at the end. So today we'll just quickly go through my background. We'll go through the different ways you can structure your portfolio, how to tap into a refund earlier, and we'll just go through some strategies on how to minimise your tax. But before we start, just so I understand who's in the audience, who's already a property investor, has like one investment property already? So, doing the negative gearing way? Yes. Who's thinking about going into property for the first time? Okay, yep, newbies. And who's going, buy the block of land, subdivide and build, 2-3 townhouses? Okay, so I've got a bit of a spread, so I'll try to tailor towards everyone and hopefully you get a tip. So a little bit about myself. So I am a registered tax agent and I specialise in doing tax returns for individuals and property investor. So I myself am a multi-million property investor, and you probably think, oh my gosh, she probably looks like she's 18, but I'm not, I'm in my early 30s. So I worked at KPMG, one of the big accounting firms in Melbourne. So I was born and raised in Melbourne, so I worked there for about 6-7 years, and then I worked in-house at a listed company there. And then I decided to open my own practice in the last 3 years. In all that time, I was doing tax returns for CFOs and high wealth individuals. So this space is my space. Obviously a member of the Chartered Accountants Institute and also a member of the Institute of Taxation. So my point of difference is really my clients or potential clients come to me with a frown, but they always leave with a smile. So that's what I'm proud about. So some of the reviews I've had from my clients, this is just a snapshot from True Local, which is like a Google site. So just some of my clients who I've helped during the last tax season, which ended 15 May. Just some of that. You can go on the website and read the rest if you want. Okay, so let's talk about structuring of your portfolio. So there are 3 main ways that you can structure your investment property. You can either put it in your personal name, so when you buy something, you can put the property in your personal name, or in a company, or in a trust. Now, which structure is right for you? That depends on your situation. So there's other structures, of course, but these are the 3 main ones. So there are pros and cons with each, and we'll quickly go through these. So if you put it under your personal name, low to set up, because it's got your name, just when you sign the contract, you just put mine, you win, personal name. However, that gives you low asset protection. If someone sues me for whatever reason, they can potentially get all my personal assets. There's no really ATO obligations, it's just doing your tax return every year. So there's no additional obligations that you need to follow. The pros is that if it is an investment property, and I'm assuming everything I'm talking about now is investment properties, if you hold it for more than 12 months, you may be eligible for the 50% CGT relief. So when you do sell your property, say you sell it for 100 grand profit, if you hold it for more than 12 months, you get 50% discount. That's the current law as today. The bad thing is that you have to pay the tax at your marginal tax rate. So if you are high flying, you might be earning a lot of money, 150,000 or 180, then you pay at the top marginal rate. So you might consider, well, I don't want to pay, 46%, or now it's gone up with the federal budget. Why don't we do it on a company name, through a company? So you need to decide all of this, which structure is when you sign the contract. It's best to do it when you first sign the contract to decide which structure is right for you. Now with a company, obviously it's a bit higher to set up because you have to create a certificate of incorporation. You need an ABN and TFN, so there's a few more things that you need to do, or your accountant will do. But obviously there are benefits, there's asset protection. So if someone does sue you and that property is in the company name, if they sue you, they only can take what's in your company. They can't take your family home, can't take anything else outside your company. So that protects you if someone does sue you. Not that anyone's going to sue you, but you know, it's always good to know. And obviously there are a few additional ATO obligations. You need to do a company tax return. You need to file with ASIC. So there are a few more things that you need to consider. Pros, asset protection. The bad thing is that when you do sell, you don't get the 50% discount. So the structure then depends, what is your goal? How many times are you going to do this? What is your projected profit? Etc, etc. The last thing is a trust. So similar to a company, high setup costs, has a few additional ATO obligations that you need to do. Trusts are good if you have family trusts. So if you're expecting to make a lot of profit by selling these, by selling your investment properties, you can distribute to your beneficiaries, who are mainly your parents, anyone in your family. And then how you get asset protection is that your trustee, so the person in control of your trust, is your company. So that way it gives you the most benefit. You can distribute your profits, which is why we're here, getting profits when you sell your assets, sell your investment property to a lower marginal rate than yourself, and then you get the asset protection through the company, so that if you do get sued, it's only within your company. But obviously that's a higher setup cost because you've got a company and a trust structure. So now we just go through some of the things I generally find from my clients. They generally do it wrong, or common mistakes. So when you're setting up your bank loan, it is very important that you do not mix your personal loan with your investment loans. They need to be separate. Do not taint them. Do not join them. Because as you know, you only can claim the interest deduction on your investment properties, not your main personal house. Yeah. So do not mix them together. And be careful. A lot of people, be careful not to take money out of your loan for holiday, saying, oh, I need to take 10 grand out because I'm going for holiday, and then 2 weeks later I'm going to return it back. No, you can't do that. Do not take any money out of your investment loan for personal use. It taints it. So be careful you don't do that. And how you get around all this is that when you set up your loan, when you set up your bank loan, day one, your mortgage broker, your bank lender should set up an offset account. So all this information, you should be talking to your accountant and your mortgage broker when you set up the loan. It doesn't cost them more to set it up correctly, but it takes them more time. So some of them are lazy and they won't tell you, or they won't do it for you. You need to tell them. It doesn't cost you any more. So these things you need to tell them and they'll set it up for you. Okay, tips for property investors. So for those who are doing the negative gearing, so negative gearing is when your total expenses are greater than your rental income. So let's put an example here. For those who are doing the negative gearing, and they've probably just done their tax return, who would be happy if they got a $6,000 refund in the tax return? Hands up, don't be shy. Yeah, a few of you. Okay, yeah, I mean that's great. $6,000 refund at the end of the year when you lodge it in September, October. But I wouldn't be too happy about that. Why? You've essentially waited 12 to 18 months to get that refund. Just say 6 for this illustration purposes. You've waited 12 months at least to get that refund. So the ATO is earning interest on your money. So what you can do is you lodge a form, and you don't have to wait to the end of the year. You can get your, say, $6,000 divided by 12, so roughly $500 or so, maybe less, $500 each month throughout the year. And obviously at the end of the year you won't have a refund. It's time value of money. Yeah, so when you want an extra $500 each month to pay down your mortgage, to pay down your credit cards, to do whatever you so wish. So obviously it's called a pay-way variation, which essentially reduces the withholding rate that your employer withholds for you. So you can go on the website, the ATO website, and do it yourself. To maximise it, which starts 1 July 2014, you should have your accountant should have done it in May, or already have done it, because the ATO takes about 28 days to process, and then your employer, if you get paid on a monthly cycle, they'll take another month. So, you know, it essentially takes about 2 months to take effect. So if you want the full year benefit, you really need to do it early May, but you can still do it now. Essentially, it is filling out like a mini tax return. So you put all your income, you put all your expenses, and you do a tax return. But as always, you've got to be careful when you fill out the form to avoid the ATO penalties. Okay, so obviously the ATO are very strict on this. Things that you need to consider is the ATO takes 28 days to process, your employer then takes 1 pay cycle to process your payroll system. The ATO has a tolerance level of about $500 debt payable, which is about $2,000 grossed up. So you can be within about $2,000 variance. If you're over that, you pay penalties. So the best advice there is talk to your accountant, see if this is applicable to you, if it's relevant for you. Obviously, you need to be employed. If you have your own practice, it's not relevant for you. So speak to your accountant, and they'll tell you whether this is applicable for you. If it is, got to do it ASAP to get the full benefit. Okay, some other tips is mortgage insurance. So for those people who are thinking about buying an investment property soon, we all know if you're borrowing more than 80%, then you've got to pay mortgage insurance to the banks, some banks, depending. So I've got an example here. So normally mortgage insurance is deductible over 5 years on a per day basis. Okay, so in my example here, Tim settles his investment property, borrowed 90%, and does a $10,000 mortgage insurance. So the question might be, how much can you claim your tax return in year 1? And there's the calculation. Yep. So in year 1, because it's pro rata on a per day basis, it's just under $2,000, and then the remaining years are shown up there. So over a 5-year period, you get the full $10,000 deduction. Claiming assets. So for those who already have investment properties, you know you can claim immediate deductions for $300 per your ownership percentage. So a lot of people think it's $300 in total, but it's not. It's your ownership percentage. So in the example, Tim again and his wife, they have a different 25 and 75% split. They purchased some bathroom curtains. So for Tim, he can claim $237, which is his full 25% share, but his wife has to capitalise because her portion is over the $300 threshold. Okay. So for those who already have investment properties, and for those who are going to build, so if you're going to build, you should definitely get a tax depreciation schedule. So this is a quote I got from LJ Hooker. That is actually quite surprising that 80% of property investors do not get or take advantage of a property depreciation schedules, and they could potentially be missing out on thousands of dollars. So to claim a depreciation, you need to get a report from a qualified surveyor, and I'm not one of those people. You just go Google and you can find someone for $500, $550, $550. They'll come out, do a full inspection, and they'll write you a report that you then give to your accountant. So what it essentially is that you can claim on your buildings, your furnitures, and your fittings. So obviously there's a 40 years you can claim your depreciation up to 40 years. So the newer the house, the longer you can claim. So if you're having a brand new house, you can claim obviously the 40 years on the cost of the construction. If you're buying an old house, already, maybe it's 20 years old, you've only got 20 years left to claim. And if you have a house that's probably built, after 1985, which is about 30 years old now, and you haven't got a tax depreciation schedule, you might consider getting one, and then you can amend up to 2 years of your tax return. It's just, you got to weigh out the cost versus the benefit of getting one. Okay? And obviously the cost of the depreciation report is tax deductible for your investment property. Key thing here is to keep your receipts. The ATO are cracking down on receipts. They've got data matching everywhere with your banks, with your when you buy or sell, when your rental properties. Data matching for them is one of their key focuses, especially for those who are building or buying your block of land and building and construction. You need to keep all your receipts. I know that's probably one of the last things that you care about. You just want to build your 2-3 bedroom units. You need to keep your receipts. Because when you eventually do sell it in 5 or 10 or 15 years' time, we need to calculate your gain. So you need to keep your receipts, either put it in a shoebox or do something with it so you've got a record. Bank statements are great because it won't fade, and if you do lose it, you can call it your bank and they'll be able to print out your bank statements of all your expenses. So the ATO's view, no receipt, no deduction. So you can claim it, but the risk is on you if you get audited, and they are increasing their random audits. Definitely keep your receipts. And when you put in a shoebox, put it in, your accountant will take care of the rest. Okay? And end of the day, treat your receipts as cash. If it's a $50 note and your marginal rate, say 32%, that's actual cash that you're going to get back. So treat it like cash. Don't throw it in the bin. Chuck it in a shoebox for your accountant. She'll be happy.
Can I ask a question?
Yeah.
What's the ATO's perspective on scanned receipts or photographed receipts?
So long as you can still see it, because sometimes they do fade,
Yes.
that's okay. Because there are secondary evidence. If Bunnings, you probably put on a credit card, right?
Yeah.
So if you do get audited or random audit, you can produce the scanned one. If they're not satisfied, then you'd always keep your credit card statements because you've got all your other things. And they'll see it, Bunnings, that date.